60% of business owners who borrow from online lenders find their actual costs are higher than expected. The culprit is often a 1.20 factor rate that quietly translates into an 80% APR. Merchant cash advances, or MCAs, operate as a purchase of future business receivables at a discount. This specific classification allows MCA providers to bypass state usury laws, the regulations that usually cap interest rates and protect borrowers from predatory fees. Even with these risks, approval rates hover around 90%. They target the urgency of a business owner who needs capital within 24 to 48 hours to manage a sudden cash flow gap. Subscribe to this channel to keep up with the latest data on alternative lending and protect your business from high-cost debt traps. Because an MCA avoids being defined as a loan, the borrower is stripped of standard consumer protections, leaving them entirely exposed to whatever is written in the fine print. That fine print usually swaps a standard annual percentage rate for a factor rate. This breakdown shows the baseline cost. A $100,000 advance with a 1.20 factor rate results in a total repayment of $120,000. That is a fixed fee of $20,000. When we apply a standard 6-month repayment schedule, that fixed fee reveals an effective APR of 40%. However, since MCAs are repaid through daily sales deductions, a high-performing quarter can actually increase your costs. If you pay the advance back in just 3 months, the effective APR spikes to 80%. This differs from traditional amortized loans, where early repayment reduces the total interest you pay. The MCA's mathematical structure makes capital exponentially more expensive the faster your business succeeds. This aggressive repayment cycle often leads to stacking, taking out a second MCA to cover the daily remittance of the first. Layered daily payments can quickly consume 20% to 40% of a company's gross revenue, leading to immediate cash flow failure. Recent 2025 SBA rule changes have made this spiral even harder to escape by restricting the use of government-backed loans to refinance these stacked debts. Deep in the contract, many funders bury a clause known as a confession of judgment. This clause grants the funder the power to seize business assets and freeze bank accounts without finance, particularly under New York jurisdiction. Signing an MCA with stacking allowances and a confession of judgment effectively surrenders your operational control and your right to legal defense. The regulatory landscape in 2026 is shifting toward more transparent oversight for alternative lenders. California's Assembly Bill 483 now mandates clear cost disclosures and enforces a 30% cap on early termination fees for commercial contracts. Simultaneously, federal courts are recharacterizing high-cost MCAs as disguised loans, which forces them to comply with state usury laws. These products are generally only appropriate for 24-hour emergencies, where a specific project has a high, guaranteed return that outweighs the cost of the advance. Subscribe to keep your business updated on these new legal protections and funding alternatives. These legislative changes provide a new shield for business owners, creating legal leverage in what was previously an unregulated market. You can find the same speed as a cash advance through healthier financial products. Alternative term loans and lines of credit fund in 24 to 48 hours with predictable installments. Equipment financing and invoice factoring are secured by the asset or customer creditworthiness, eliminating the need for a personal guarantee. Use BusinessLoan.Directory to cross-reference these specific alternatives before committing to a daily remittance contract. The platform compares offers from 75 different lenders in under 2 minutes using only a soft credit pull. Spending 2 minutes to compare these 75 lenders ensures that a need for fast capital doesn't result in a contract that consumes your revenue.